ideas, you can be invited to their forum. Maybe you can get someone on the board of that company onto your company, or you can have an advisory panel. Corporations are really, really important. And I would say getting to know those parties is pretty important, not only here domestically, but in my view, the world is very, very flat from a technology perspective. It's really getting to know the right parties in particularly Western Europe, which is probably most comparable to the U.S., would be very helpful to the growth of the business. I can go through a number of other things, but I really want to make sure that we get to answer questions. I'm sure everyone has plans for later on tonight or this weekend. And is this my last slide? Maybe not. Oh, there's one more, maybe not. Yeah, it's page 5. So I had a couple of the slides in here, but I just found, I think you said you were broadcasting this or something, and I just want to be careful of what's being... Recording it. Yeah, recording it. There's some stuff you just don't like in the public domain, just because competitive reasons, disclosure issues, etc. But I would just say there's a lot of components which are important in building a business. But the most important thing is to figure out what problem are you going out there to solve? What is that solution set you need to solve that problem? And how can you go out there and make it happen? And you got to do a lot of simple thinking. You hopefully have a number of team members, whether on the technology side, on the go-to-market side, other people who understand that category. And it's absolutely amazing that if you can figure out a solution, how quickly these companies can grow. The one thing which has amazed me over the past 5 years, I used to think that most companies were created in the major centers of the world, New York, the Valley, obviously, Berlin, obviously Shanghai, and other parts of the world. But increasingly, we're finding amazing companies in Minneapolis, and I was just up in Kansas City a month ago. I mean, it's amazing where you've had people who are in industries. So maybe they were in the freight forwarding industry. So the more classical sense, where they saw a problem. Just met a company recently from Bentonville, Arkansas, where the guy sold stuff into Walmart. But he saw that things weren't being done efficiently. He thought, well, maybe he could do it by building simple software. He built simple software. He or she built simple software. They're very focused on certain categories, whether it's the vet industry, the freight forwarding industry, obviously e-commerce, a lot of different categories. And these companies have just grown up dramatically. And a lot of these businesses, some businesses we see are actually growing over 100% year over year, which when you get up to the scale of 10, 25, 50 million bucks is obviously pretty impressive growth. So,
okay, I have a few questions, but you already covered a lot of ground. I think it's a great recap, a great perspective on the whole domain. So, a couple of things I wanted to ask you. So, in another session, some people mentioned that if you want to understand what the corporates are planning to do, it's kind of a good thing to listen to their earning calls, which is probably not what most founders do on the weekend, so they have free time. What do you think about that?
So
earning calls.
Number one, what's great, all those earning calls are usually taped, so you should definitely do that. I mean, I think I mentioned before, go to the company's website, look at all their press articles. So what have they been announcing lately, particularly things which are in your category? If you go to the investor relations page of any public company, not only will they have taped their earnings call, they'll probably have their slide deck up there too. But what's really valuable is if you can get sell-side research. So let's say it's Oracle or any company. Usually the investment banks, Goldman, Morgan Stanley, but even the little guys, will write a research report on that company. So it really gives you a good idea of not only how they've done, but where they think they're going and how they're going to get there. Maybe new product launches, new strategies, maybe new partnerships, and really understanding that is important. And then the other thing which is very important, and certainly a banker does this, certainly we do this all the time. We subscribe to Gartner, 451, Forrester, all of these organizations that do research on all the different categories of technology. So when we talk to, I don't have to go to compliance, we talk to a software compliance company. Well, number one, we know a lot of the space. But we'll go to a third-party source like Gartner, Forrester, pull down their material on compliance and understand, well, who do they think all the category killers are, what's going on, what are the product features, the pros and cons, who's had problems, who they think is winning customers, who's losing customers. So it really gives us a very good idea. Is that a good client? Is that a client that we think we can make it happen? And I mean, the name of the firm, as you're looking up right-hand side, is Sparring Partners. And I named it after myself. But if you think about what we do, we try to get our, like a sparring partner would in boxing, we get our clients ready for that next event. So hopefully they won't be surprised by anything. Whether they're raising capital or selling the business. So if you think about understanding the ecosystem and the amount of information which is available for free on the web about what's going on in your category is just critically important. We talked to a company, about 6 months ago. This guy was a little surprised he never did this. But he was going to compete against MindBody. I don't know if you know what MindBody does. MindBody, if you want to go to a hair salon, go get a trainer, or sort of book a time with a small business. MindBody is a public company which offers scheduling software, payment software, all that sort of stuff. He had never read any of the public material on their website. And therefore, when we sort of walked him through, well, this is what the big Goliath is doing in the sector, he's like, oh my God, I didn't know that. I didn't know that. So it's just really, it's really, important for yourself to really try to understand what's going on in the category. There's just so much information out there, far in addition to just the earnings calls.
Another thing, before I turn to the audience, I'm probably going to keep the Q&A short because it's been a long day. But there's a couple of quick questions. So, what do you think about the role of boards? So, in San Francisco, we had a full session talking about that. Some people were surprised how important that is and how it's never almost talked about. What's your take on boards?
So, boards, I think it depends on who your board member is. I mean, there are some really outstanding board members who are very aggressive, very, very involved. They really are passionate about helping their companies grow.
What is it supposed to do?
Pardon?
What is it supposed to do?
They are the least important thing of a board, by and large, is wiring and money. I mean, ideally, if someone's raising money, hopefully they're going to have an opportunity to not only get that financing party on the board, but hopefully it's an individual that you're going to be happy that they're going to be sitting in the front seat of that car with you for the next couple of years.
So you're talking about an investor on your board.
So then again, there's other types of board members. My view is you want to get a board member who understands your ecosystem. I mean, if you have a compliance software company, to go get someone who's run McDonald's is not a wise idea. Why? They're going to know nothing about all the components of software, probably all the components of compliance, the target market being banks or financial institutions, or whatever it happens to be. So if you think about your board, you want people around you who aren't going to call you up at 6 o'clock on a Friday night and say, did you hit your weekly quota? And that is a waste of your time. It may not be a waste of their time, but it's a waste of your time. You want board members, both those financial ones, as well as those that are non-financial, to really be value added. But I would just say, I would worry less about board members and think about who do you want in your ecosystem? Who do you want as advisors? Because a lot of people don't want to go on boards. There's, there's a legal obligation, governance, heartache, blah, blah, blah. I mean, why would anyone want to go on a board? To be honest, it's not a good use of time. If you really think you can impact the outcome of the company, great, talk to the CEO, meet with them, sit down with their go-to-market people, sit down with their customer success people. I mean, really spend time with them and say, gee, you can't pay me cash now, great. Why don't you give me some options? And one thing a lot of companies are doing more and more of is having user groups. So if you think about whatever the product is that you're offering, whether it's consumer or enterprise or even life sciences, having a user group of people that are sort of on your council and can have calls once a month or you can just independently reach out to them is so critical because you really want the best brain power out there helping you make your business happen.
Kind of interesting. So it's reasonably common in a number of like software, like B2C type of businesses, but for B2B, not that common to have like engaged user group, like alpha testers or something.
Well, no, well, we actually see that a lot. Where on the enterprise side, people will be coming out with a new feature, and as opposed to rolling it out to everyone, they're going to pick 10, let's say you got 100 clients, you're going to pick 3 to 7 firms to say, gee, we're coming up with this new feature. We want to trial it with you. We want to test it with you. And by the way, the reason people should come out with new features isn't because, at 9 o'clock at night, the CEO thought about it or the CTO thought about it. It should be because there's demand in their user base, or their user base had a pain point. They didn't have that information in real time, or they didn't have that additional field of information, and therefore they built that additional feature, and they should really just move it out to a couple of people to pilot it, test it with, to really make sure it works, and it does what everyone was hoping it was going to do.
So, final quick question on my side is, so you talked about private equity groups being more active in the past few years. As a startup founder, how do you engage with those people? Because you don't really meet them so often in startup events where you mostly meet VCs. So what's the channel? How do you get on their radar?
The radar of the
PE. Or how do you get in contact them?
So I would not. So there's different types of investors into a company. If you're a smaller company in tech-enabled by and large, it's called venture capital. You can call it early stage, which means probably pre-revenue. I told you I don't like this ABC stuff. That's kind of not useful for a lot, increasingly more and more people. But it's just how much revenue does a company have? And if it's zero-ish, you want to go to the seed and very early stage funds. If you got $5 million of revenue, you're going to go to the growth equity funds. If you have north of 20 million, you go to growth equity as well as the PE funds. I would just say PE funds really mean that they're taking, by and large, control of the company. So they're going to buy majority control.
And
historically, they've been EBITDA positive companies, and historically it's been in manufacturing, where KKR and Carlyle started, and moving more and more into business services, owning, dental practice management businesses or, whatever it happens to be. But I think the key thing is think about your business. How can you grow it? What's going on around you? What's the competitive environment? And then looking at all the other companies that have been financed in the sector, and you're going to find out, wow, these 20 firms do a lot of cybersecurity, or these 40 firms do a lot of whatever, therapeutics in the diabetes world, or these half a dozen firms do a lot of devices, medical devices. So if you think about it, there really are firms that really try to specialize in various categories. The other thing, just real quickly, making sure you know the person you want to approach there. So if you're approaching a VC fund and the guy was at hardware companies, or a software company, he's the wrong person to approach. So in particular, you look at their background, where have they been an investor, where have they been a board, they had operational experience. Your story is going to resonate a lot more if it's well targeted than if you just happen to send a blind email to the wrong person.
Okay, we're going to take just 2 or 3 questions. Again.
Hi, Warren. Thank you. This has been very helpful. We heard a lot of those processes fail, right? I mean, I would say that most of the acquisitions, fall apart. What can we do as entrepreneurs, as founders, as head of companies to, increase that success rate in the context of a process, a structured process?
Yes. So I think there's slightly different M&A versus financing. I think it depends upon, where the company is in its revenue position. I would say if a company has revenue and it has a growth rate, it's going to have a pretty high likelihood in today's environment of a positive outcome. Number one. Number two, I'll give you some of our anti-portfolio. So we've done some sell sides. And I'll give you an example of a company we were selling. It was owned by a brother and sister in the dating sector, but a big company. They had no real outside advisor. They wanted to use a partner at a law firm that had never done any M&A deals into the big players in the online dating space. Guess what? They over-negotiated their hand. The business unit owner of the company that was going to acquire it decided, you know what, if that person's pushing back that much, and maybe a little bit on the trust me side, you're going to comment. But trust me, they were saying, you know what, this is probably just someone I don't want to work with. So it almost, where they basically, what I call, they broke the China, right? So they just sort of pushed too hard, and the person realized it. And I think this is where sometimes having an institutional investor on your board, a VC or a private equity firm, they're going to be able to shake a bit of sense into you. We certainly do that as a banker. We've certainly warned our clients. I mean, one time we really see this happen is when there's entrepreneurs that don't have generally a financial investor. They think, oh, this is it. This is my baby. I really want that extra $5 million. What are they doing? Blah, blah. And it breaks. Right? And they just go, gee, this is just not someone I want to have come work with me. Right? So I think the things to do to try to answer your question, Christian, right? Try to answer your question, Christian, is be prepared, have realistic expectations, and understand, on the previous slide, understand those terms and try to walk through those terms so you really have a good idea as to what expectations are. Obviously, a lawyer, if they're focused in your category, they're going to have some ranges and some benchmarks. We definitely know sort of in our category what's happening, and you just have to be able to be somewhat realistic and look yourself in the mirror and go, wow, who am I kidding myself? This is a reasonable deal. Yeah, it could be more, but who knows what's going to happen in the market over the next X period of time. Bulls and bears do find pigs get slaughtered. Let me be realistic and accommodating. Particularly if you're going to take money in, keep in mind, you got to work with that person. You don't want to become too controversial, too adversarial in your negotiations where you're going to sort of say, God, the best day of your life should be when you close a deal. It shouldn't be the first day of your life not being happy. Particularly about a financing partner. And that really is where someone is sitting in the front seat with you the next 3 to 5 years or maybe even longer. So you really want to make sure they're right. And if you really think you can build a great business, plus or minus a couple of points, plus or minus almost anything isn't going to matter to the outcome. Do you have someone, I just have to know Jeremy very well, but someone like Jeremy's already done a bunch of companies in that sector. He understands it well. He understands the strategic. He's going to, if I was a CEO, I was going to say, gee, Warren, you're great to take up the $5 million. You're going to become a chairman or a vice chairman after you get to $5 million and say, no, you just can't manage a team of 200 people or whatever the story happens to be. You just have to be very realistic on these situations. But I would just real quickly, the better your metrics, so how many customers, how quickly adding customers, are the customers staying with you? And when those customers stay with you, are they eating more of the dog food? So they're buying software or using whatever it happens to be. Are they using more and more? And if you're selling enterprise software, they first start out with 5 users in the company. Then you go up to 55 users in the company. I mean, those are, very important data points which allow us to get much better transactions. And just real quickly, going into the public markets, companies that have high retention rates and, negative net churn, which means they had 100 customers last year, say they had 10 million. They had 99 customers out of that 100 1 year later, but they were producing $12.5 million of revenue. It's an increase of 25%. That's a huge data point. So there's a lot of metrics which go into this, which is why I said, hey, you should definitely think about a lot of things, but thinking about your business, how to grow it, what are the right products, product features, what's the right team, and it's a 24/7 job.
So number one, traction. If you don't have enough traction, you be personable and reasonable.
You have to be. Even in this environment, you'll have to be.
So the last question, I think there was somebody around here.
Can you talk a bit more about earnouts? What kinds of terms are out there? What percentage of the deal? Who gets the earnout value? Is it the founder who's staying with the company?
So let me just go to value. Value is pretty easy. Whoever owns the shares, remember, the earnout's going to the shareholders. So that's how it's waterfalled out over the future period, 1, 2, 3 years. I would say we end up doing a good number of earnouts, and most of them we've structured very well. So I'll give you a good example. We did an earnout for a company up in Boston. We sold it to a London company. They got a wire transfer of X at closing. 2.5 years later, they got 92% of X. So basically, they got the same amount of money 2.5 years later. But what we did was, so it was based upon, in their case, EBITDA. What we made sure is that if the company wanted them to fly first class, and that was a company policy, they wouldn't be charged for first class on the earnout basis. Or if they had to go in the company's healthcare program, our earnout was still structured based upon what they were paying before they were acquired. So we really structured it very well so that we could maximize your earnout. Some are based upon EBITDA. We've done a number of earnouts that are based upon revenue. We've done one earnout based upon number of customers. So once again, if you have parties that are hungry, so once again, benefit of strategic. Strategic really want it. They want the team to stay, all these sorts of things. The ability to negotiate very good terms is enhanced. And once again, it's never that you want it. It's never that me, the banker, want it. We're sort of telling them, wow, there's other potential acquirers or other potential financiers out there that really want this, and they've suggested these terms. So once you get the hooks into them, they decided strategically they want to do it, your ability to negotiate all these different components is enhanced dramatically. No, I think probably only 25% of our deals. And I would say lately, we've been doing a couple of them. Why? Because our CEO clients have high confidence in their numbers. Maybe they really do have 125% net retention. They don't want to give up all that upside, but to get a wire transfer in today for $25 or $125 million, and then still being able to get additional bites of the apple over the next 2 or 3 years, that's pretty attractive. They've been able to de-risk themselves by taking a lot of money off the table, as have the VC funds or growth equity funds. But they don't want to go do anything else. Great, they want to stay with their baby again for another 2 or 3 years. And it really gives him or her an opportunity to get another big wire transfer. And what's really good about an earnout, of course, it's payment for stock, so it's long-term capital gain. The one thing I just do real quickly, we have done a number of situations where, and they didn't, Jeremy and the guys didn't talk about it, where the companies aren't doing well, and there has to be an incentive for the CEO to go through the process for the 6 months to sell the company or whatever, however long it takes. But because of the amount of capital they've raised, the waterfall won't get down to the common equity, which is owned by the founder, the management team. So we help before we go into a deal, we want to make sure there's a carve out. So, we know a lot of companies that are sort of going sideways at $10 million for the last X number of years. They've raised a lot of capital. They said, we're going to pivot, we're going to be successful again. Then they weren't, and then they raised another $20 million, we're going to pivot and be successful again, they weren't. But management's going, I'm getting a lot of knocks on the door. I can go do something else, but just stick around, they got to do a carve out. So no matter how much, usually it's 10%, but no matter what the business is sold for, 10% of that's going to go for the management team. And it's a pre-arranged structure. It's how much goes to the CEO, CTO. I shouldn't say CFOs are hired hands, they don't get much of it. But we see a lot of that in these companies which raise more capital than potentially what's going to be sold for.
So I think we're a little bit over time, so I'll just ask you if you have some, let's say, final parting words, particularly for the entrepreneurs that have been, quite patient, staying around for the entire day, listening to how they can prepare for exit. So what according to you should be the kind of takeaway ideas?
The reason all of you have built or are building or will be building a business is that you're passionate about something. Do what you're excited about, focus on it, but be halfway realistic that if things are tough out there, you've tried to pivot once or twice, okay, sell the company or close it down, whatever you need to be, but don't give up. When I look at the companies that have been created over the past dozen years, I think about, we met the Open Table people, thought it was a stupid idea. But I mean, there's just some fascinating ideas out there that are just amazing, and I would not give up. I'd be really passionate about it. But remember, you're really good at what you do. You're not good at being a lawyer. You're not good at being a banker. You're probably not good at being a doctor or whatever else. You want to go to a specialist and someone who can use their wealth of experience, the scars on the back and the lessons learned they have to make it a smoother and easier path. So I would just say, focus on what you want to focus on. And where you're not great, go try to retain someone who you think can really be a good guide and a good shepherd to help you through that particular issue.
Thanks. I think that's very nicely.